Very important concept, right? So what is the difference? 20,000. But we already, recorded here in applied side 200,000, and our actual is 180,000. We write it down on the debit side here. So it means our predictions are not according to our actual senses. So it means on the end, this is not balanced. We need to adjust. So if we overestimated, so it means our cost should be decreased or our cost should be increased. Think about that. We forecasted 200,000, but actual one is 180,000. We overestimated 20,000. So our actual cost should be
decreased.
Product cost. Product cost includes direct material, direct labor, and manufacturing overhead. So our total product cost should be decreased or increased. Chandra, Christine, Arone, Min, please do participate. This is very important concept. Right, because we overestimated in our mind or in our forecasting formula. We thought that the cost gonna be increased, but now actual cost is decreased. So we should decrease the product cost. To decrease the product cost means we should less the product cost. We should less from cost of goods sold, because we charge higher cost to the products, right? Cost of the products when they are sold, we call this cost of goods sold. We just made an entry as well. So that expense is already increased, we should decrease. So it means in case of overestimation, the name is called over-applied. Over-applied means that overestimation is greater than the actual. Understand? Now, the opposite one, which is the applied, is 150,000 and the actual is 200,000. In that case, our predictions are not according to reality or actual expenses. Now what happened? Actual expenses are greater than our forecast. It means our forecasting is bad. Understand? We could not find out, we could not apply it, we could not estimate it, we could not forecast the real data. Something happened, and what happened? Our actual increases. So we underestimated or we overestimated. In this case, we underestimated. So we call this concept under-applied. So when our actual cost is increased, so manufacturing, the product cost is gonna be direct material, direct labor, manufacturing over direct. I cannot write it down here. Direct material. Let me write it down through my direct labor and manufacturing overhead. So this we already calculated in our, before we, we received the order, we already gave them the unit cost, right? Because we have direct material, direct, labor and manufacturing overhead we estimated. We can find out the, this is the applied one, for example. manufacturing overhead. So this is the product cost. Right? So, but at the end, our actual is greater than the applied. So we will increase the product cost or we will decrease the product cost. So it means we will be adding the difference. Difference is 50,000. So we will be adding this 50,000 here. So what we are adding? Under applied. Understand? Min, Arone, Christine, Chandra?
Yes. Yeah.
Yes.
Yeah.
Right? So when we go to the slides, then it won't be very problem for you to understand what I'm saying here. See? So work in progress, debit side, which means increase. So over applied means that we estimated more than the actual one. Under applied means we underestimated or our actual is higher than the our actual is higher than the applied one. So this concept is called under applied or over applied. So let's just talk about this. Applying manufacturing overhead. Okay, manufacturing overhead is to be applied. Okay, what's going on here? Applying the manufacturing overhead. Applying the manufacturing overhead. Okay, yes. Now, applying the overhead cost to work in progress using predetermining overhead rate. So when we apply the predetermining overhead rate, so remember predetermining overhead rate is written on the credit side of the manufacturing overhead. So it means predetermining overhead rate is always on the credit side. So it means predetermining overhead rate is is credited to manufacturing. This means manufacturing overhead is credited. So when you apply the cost to the applied cost, so entry would be credit manufacturing overhead and debit would be work in progress, because when we calculate the unit cost is equal to direct material, or manufacturing cost is equal to direct material, direct labor and manufacturing overhead. So this is the cost of work in progress, right? So that's why work in progress increase. So these all increases the work in progress, right? So this is applied one. So we don't write applied here because we are going to use at the end the under or over applied concept. So that's why one is increasing, one is decreasing. So in that case, account remains the same, only debit and credit side is going to be hit. So that's why we don't use the word applied over here. We make a one account that is manufacturing overhead, and the right hand side is called credit, which is applied. The left side is called debit, which is actual one. So that's why, right? Okay. Now accounting for non-manufacturing cost. Non-manufacturing cost is like salaries of head office, admin expenses, and selling expenses, right? Includes salary expenses, the employees, right? Advertising expenses for increasing or increase in sales or whatsoever, increasing the sales chances or whatsoever, promotions, this kind of stuff. Commissions also belongs to the selling expense. So how we are going to account for the salary expense? So when expense occurred, not being paid, expense is going to be recorded. Not paid, we create liability. So it means cash is not involved in expense, so we create liability. So like salaries expense to payable. If we pay, entry would be salary expense to cash. right? Since cash is not involved, so we create liability. Salary expense to salary payable. Similarly, with the expense not being paid, advertising expense to advertising expense payable or accounts payable, whatsoever, you can do that. You can create liability. Chandra bin Arone, understand?
Yes, understand.
Yes.
Good. And now, transferring the unit cost from work in progress to finished goods, right? So work in progress, here we have direct material, direct labor, and overhead applied. Understand? The difference will go to work in progress. That's it. And that cost, when it is when it is completed, so completed products will be shifted to the finished goods department on a warehouse of finished goods. That's it. So there are three types of inventory. Raw material, you purchase raw material, there is a go down over there. So you issued a material requisite form, and there is a factory over there who convert the raw material. When they are converting the raw material, you are employing the direct material, direct labor, and manufacturing overhead. And you make the finished goods, and that finished goods is transferred to the finished goods warehouse. So from work in progress, all these are applied. Direct material, direct labor, manufacturing overhead. So you add it, so that would be the cost of goods manufactured, not the goods sold, the cost of goods manufactured. Okay, we completed 3,000 units. We completed 3,000 units, and the cost is 300,000. So this all costs gonna be transferring here because we completed manufactured goods. We manufactured the goods, right? And from those, whatever is sold is going to be written here. So that would be cost of goods sold, right? We will decrease that amount, which, for example, half of them are sold, 150, 1,500 units are sold. So it means 150,000 worth of cost of goods sold is going to be decreased from here. So that is cost of goods sold, because those are the units sold, right? And you add the sale price, adjust it, and that will go to the sales account over there. But from the cost point of view, from 150,000 worth of goods has been converted from finished goods to sales. Understand? Min, Arone, Christine, Chandra?
Yes.
Yes. Yes.
Good one. Good, good, good. So when finished goods, when you transferred from work in progress to finished goods, entry would be finished goods increase, work in progress